Good afternoon, everyone. So thank you very much for attending this webinar today and taking the time out of your day. It's on defending your portfolio, high quality global government bonds and more. I'm Mai Platts. I'm the Director of Key Accounts and Advisor Business, and I'm joined by our Chief Economist here, David Bassanese. Before we start, just a couple of housekeeping notes here. So we will be sending the recording of the session along with the slides following the webinar. If you would like to ask a question, please type it into the widget there that you can see on your screen, and we will attempt to address those questions at the end of the webinar. Yes, so to make our legal team happy here, so our disclaimer that this information is general in nature and doesn't constitute personal financial advice and doesn't take into account any person's financial objectives. For those of you who would like to keep up to date with what BetaShares is doing, we have on our website our insights, data, blogs, fund information. Just also wanted to share with you all that we will be having more of a deep dive on fixed income and portfolio construction with Vinny Wadera, our Executive Director of Institutional Advisor Business, and Chalmers De Silva, our Senior Portfolio Manager, in early July. So we'll certainly send that around through to you once the date is confirmed. For those of you who are avid social media users, you can certainly follow us as well on the regular sites. So we have LinkedIn, Facebook, and Twitter as well. So as I mentioned, it'll be myself and Dave today sharing our insights. And what we're going to cover firstly is Dave will share an economic outlook, what's happening in markets at the moment. We'll also go through the case for bonds and diversified portfolios, a bit of a recap there, and then we will share with you our newly launched BetaShares Global Government Bond 20-year ETF, which is currency hedged, and ticker is GGOV. So I will now hand over to Dave for your economic overview.
Thanks, Maya. Thanks everybody for joining us today. For what we think is a pretty exciting new addition to our fixed income suite of products. What I wanted to do today is just spend a few minutes really giving you a bit of an economic update. And really, at the end of the day, obviously equity markets are rallying strongly at the moment. There's a lot of hope about V-shaped recoveries, but I still think a lot of risks still out there, and just the case for why having some sort of bond exposure, some defensive exposure in your portfolios, just in case things do go wrong, still makes sense. But again, just as a value add for you today, give you a bit of an update on the situation. Firstly, if we just go to the first slide there, really, so this is again, markets are like completely looking through this data, but just to give you an idea of where we are in relation to previous downturns in the global economy, that is the market PMI index. So it covers both services and manufacturing across the world, so Europe, Asia, United States. And as you can see, in April, it really just fell off a cliff with the lockdowns, much weaker than even at the bottom of the GFC, and certainly much weaker than the last recession in 2001, the sort of dot-com bubble recession, if you like. Now that should bounce back, I mean, as we're seeing, but the question is, how far and how fast that bounces back. But the situation, that's where it is at the moment. So effectively, you could say this is not a recession, this is depression at the moment in terms of the last month or so, in terms of global economy. Now things will improve, assuming no second wave, and we do gradually reopen, but I still think there'll be an improvement toward recessionary conditions, still quite weak conditions, but nonetheless the rate of change is toward the positive, and that's sort of what the markets at the moment are focusing on. There's some things to look at. If you look at the virus situations, just a slide here on the number of deaths, rolling number of deaths and across a number of countries. I hate to be morbid about that, but deaths, I guess, ultimately, given that the testing has gone up in a lot of countries, the new cases actually is a little bit of a distortion nowadays, because, if you test more, you're going to find more cases. So I guess, ultimately what's relevant now is the number of people actually, dying from from the disease. And as you can see, it's come down. This is what's getting markets quite excited. The curve has flattened. And allowing scope for some reopening in Europe, the United States, and in China. But I just make the point, like we're certainly far from over. Like it's still uncomfortably high in many, certainly outside of China, and there's question marks over, whether the data is being fairly reported in China. But let's focus at least on the United States, where they are opening up again gradually. But the number of cases and certainly the number of deaths from the coronavirus is still, I would argue, uncomfortably high. But nonetheless, there's immense political pressure to reopen up the economy and take their chances. If they open up and there's a flare up again, then they'll have political cover to be able to shut down again. But I think at the moment it's just hard in democratic countries such as the United States to keep things closed, for an extended period of time. So that's the risk we're sort of facing at the moment. And if you look at the policy restrictions, this is a chart that comes from the University of Oxford. There's a school there that actually have compiled an index of the restrictiveness of policy across a number of countries, looking at the extent to which workplaces have been closed, schools closed, public events being barred. And so, look, as you can see, it's been ratcheting up in policy restrictiveness over February, March and April, a gradual easing back of those restrictions over the last few weeks. But the 2 points I would make is say, we're certainly not back to where we were prior to the crisis. There's still a number of restrictions in place in many countries. And also the easing of those restrictions remains quite uneven. So Asia, because it's been more advanced in the crisis, has obviously eased somewhat more than in Europe, and the US, even less so, but probably following. But again, a key point of this chart is policy easing, yes, but it's been gradual and uneven across the global economy. So that's why I still think we can't get too excited about the shape of the recovery at the moment. Nonetheless, if you look at the share market, we've had a pretty impressive rebound in the market. So 35% decline during that February-March period, where governments around the world went into lockdown. So it really was the fastest descent into a bear market in US history. So if you focus on the S&P index, was down 35% within the space of less than a month, fastest decline in history, and really probably one of the fastest rebounds in terms of this stage still a bear market rally, but maybe it could go on. But certainly, given the depth of that decline, a furious rebound, at least initially, wasn't a surprise. But the markets have continued to push on at the moment, and as you can see, after a few weeks of stabilisation, this week the market has started to push on to new highs in this rebound. And just in the last few days, of course, the markets have got particularly excited about reopening. And at the moment, the markets are trading at a price to earnings ratio in the US of about 21 times forward earnings. It's a level we haven't seen since the dot-com bubble in the 1990s. Bond yields are clearly lower than they were back in the 1990s. So you could argue at a stretch that high valuations are justified by very low bond yields. In the US case, 0.5%. But I still think in an outright sense, I still think you can't ignore the fact that the overall PE ratio is very high, and I think earnings are still under downward pressure in the US. So I'm still a bit dubious that this rally can continue. Maybe we don't revisit the lows, but I certainly think a decent pullback at some point over the next few weeks to months is still likely as the shape of the recovery. Basically, what we need to get through now is the economies reopen. We get the initial bounce in some of that data. Retail sales that have been plummeting in a number of countries will obviously bounce back to some extent. Business confidence, consumer confidence will bounce back. But thereafter, it's like, will it keep rebounding, or will the fact that people are still scared about contracting the virus restrain that recovery? And also a number of companies that, basically couldn't survive the lockdown period that will go bankrupt and default on some of their securities and those sort of risks for markets. So I still think it's certainly grounds for caution, and certainly given where we are in terms of the market today, grounds for caution. If you look at our economy, this is a chart from the Reserve Bank's recent quarterly statement of monetary policy, and it looks at various scenarios. And really their baseline scenario, and that's assuming a gradual, you know, and again, in the case of Australia, we're going through our winter. So we're, you know, there's some debate about whether the COVID-19 is easier to catch in winter versus summer. Still mixed evidence. We know clearly the flu is easier to catch in cooler months than warmer months. So I think we're going to be cautious in the extent to which we lift restrictions. So the RBA, on that cautiousness of lifting restrictions but no second wave, still has, you know, growth slumping in Q2 and then a moderate rebound thereafter, but still activity being well below the levels it would have otherwise been at even over the next couple of years. And maybe an easier way to think about that is the unemployment rate, which is currently spiked up to about 6.2%. And again, it only went up, it would have gone up a lot higher were it not for the fact that about 500,000 people, when surveyed in the latest labour force report, basically said they weren't working, but they weren't even bothering to look for a job. So they were basically not counted in the labour force, and that held down the unemployment rate to only 6.2%. But we did have something like 600,000 jobs lost in the month of April, which is just quite unbelievably staggering. And that'll take a while for that to be recouped. So look, bottom line here, the RBA, and you know, I would concur with this, as the unemployment rate is going to push on higher, probably to 10% over the next couple of months, and thereafter decline, but this time next year still be around, say, 7.5%, even 8% on a gradual recovery. There is some, you know, they do have an upside scenario. You certainly can't discount that, in which case, but even their upside scenario would suggest that we won't get back to the unemployment rates we were at prior to this crisis until mid-2022, so still 2 years away. And, you know, last but not least is if you think about the second wave, I mean, again, the markets are just ignoring this at the moment, but you definitely, from a historical point of view, you can't ignore this. Every pandemic since 1918, and I'm talking the 1918 Spanish flu, the Asian flu of the late 1950s, the Hong Kong flu of the late 1960s, and even the swine flu of 2009, you did get second waves of the infection. Now, and you know, if it's serious enough, you could see lockdowns, you know, reimposed. That would be a worst case scenario. Now, it is also possible we do get, you know, clusters of new cases, and they will be able to be, you know, tracked, and the people affected quarantined without requiring lockdowns. But the point I'm making is that, yes, a second wave is a risk, and history suggests it's a risk we shouldn't discount. But even if we don't get a second wave per se, the mere risk of a second wave will cause consumers, and particularly businesses, to remain cautious over the next year, at least until such time as we get a vaccine. So when you think about business investment, which is a major cyclical driver of the economy, I mean, that has been cut back sharply over the last few months, and that's not going to come back quickly in a big way, because businesses are still going to be very cautious about the outlook over the next year or so. Meanwhile, we've got, you know, a US presidential election coming up. You've got US-China trade tensions resuming, and as I mentioned before, you've also got valuations at arguably very high levels, and going higher if earnings continue to decline. And I think there'll be further earnings downgrades around the world, but obviously most specifically the US market. So the market will be trading at very high valuation at a time where there is risk. So there's the, you know, grounds for caution and a grounds to have some defensive exposure within your portfolio. And again, we think long duration, if you're going to have a bond exposure, long duration government type bonds make a lot of sense. And with that, I will hand over to my colleague Mai, who's going to go through the case for bonds in more detail, and then specifically the case for the type of bond exposure that this ETF offers.
Thanks, Dave. So if we talk about the case for bonds and diversified portfolios, I think what we've seen in this recent period of market volatility is that there certainly has been more of a focus from a portfolio construction perspective on the defensive assets and whether or not they've performed, you know, in this period of time. So what we're keen to highlight is that not all fixed income exposures are created equal. And there are some insights, and we're happy to share some insights as to what you really should look for when you're selecting fixed income funds for your clients. And as David said, we'll also share the insights on the GGOV, our newly launched long duration government bond index. So if we take a step back a little bit, asset allocation, as we know, is key in portfolio construction. And in portfolio construction, there are essentially three sources of excess return. So when we talk about excess return, we're talking about returns over the risk-free rate. So you can invest in equities, so exposure to the equity market. On the fixed income side, exposure to duration. So basically, in exchange for greater price sensitivity to interest rates. So what that means is generally longer duration bonds will offer higher yield, and because you're compensated for taking a more interest rate risk. You have then credit risk as well, so exposure to credit, which is another source of excess return. And again, investors are generally compensated for investing in corporate bonds, taking a little bit more risk compared to government bonds. And we'll certainly flesh this out a little bit more and discuss the relationship between corporate and government bonds. So what are the problems with fixed income benchmarks? So firstly, liability weighting. So why is that an issue? So what it basically means is with the benchmark fixed income indices, they're liability weighted. So the companies that issue the most debt will have the largest representation in the index. And basically what that means is that the risk return characteristics of that index can change over time, depending on the types of bonds being issued. And what we've seen, particularly in the Bloomberg Ausbond Composite Index, was that due to some heavy government bond issuance, you had, again, that composition of corporate versus bond exposure in that index change over time. And basically that can also change the duration exposure of these bond indices because of the new bonds that are being issued. So what BetaShares have done is we've taken some time to really understand some of these issues and really focus on a couple of product principles. So firstly, we have set out to achieve the following. So we definitely believe that fixed income should be efficient and low cost and can be used as building blocks in your portfolio. And we'll certainly discuss that a little bit later. Liquidity is really important in fixed income. And what we've seen in the past sort of few weeks, months, is that liquidity is very important in the fixed income space. Fees are important. And what we're looking at there is not just management costs, but buy-sell spreads and other implementation costs should be considered in sort of the product development space. And we also understand that the Australian and global bond markets have different sources of return, and they can be combined or separated to a more optimal outcome. And as I mentioned before, we believe very strongly that fixed income funds exposures should have stable risk profiles, both from a duration and spread duration perspective. So what we've tabled here is a checklist for selecting the right fixed income ETFs. So firstly, what are you looking for in your fixed income? So is it diversification? Is it income? Is it for growing income if rates rise? Then what is your market view? So is your market view in line with the fact that rates will rise in line with the curve? Will rates will stay lower than what's already priced in, or will rates move higher than what's already priced in? And then when you're selecting exposure, as I mentioned in the previous slide, fees and liquidity, return, and the actual quality of the portfolio is very important. So what BetaShares have done in this space is that we have a range of fixed income exposures across the sub-asset class, across hybrids, cash, floating rate, and fixed rate. So you as advisors do have the tools to construct a fixed income portfolio for your clients that you know will do what it needs to do in whichever market condition. So here is just a table that we've put together. It's a bit of a summary table of the portfolio characteristics of our fixed income suite. I won't go through it, but as a reference point for you there, it just, again, provides the yield information, costs, distribution information of the range of funds. So you'll have that in the deck that we send you after this webinar. So here is a chart that's for us is very important. As I mentioned, our strategy really is about providing cash and fixed income building blocks for the investors. So our funds can be slotted across the interest rate risk, so duration and credit risk spectrum. So again, you can see sort of depending on floating, fixed rate, corporate or government bond issuances, that we have a fund relevant in that space. So I'll quickly provide a bit of a short recap of some of our fixed income funds. So starting with cash, many of you have already been investors into the fund. AAA is the largest fund that BetaShares has, 1.7 billion assets under management. It is cash in at-call notice accounts. What our advisors are using this for their clients really is as a strategic cash allocation. What we've shown here is the current interest rate on the fund is 70 basis points, 0.7% per annum. And we've just included here a bit of a comparison table looking at other cash alternatives in the space. A lot of our advisors are using AAA in lieu of platform cash, as the pickup is a lot higher. On the bond side, on the floating rate note side, we have Coupon, BetaShares Australian Bank Senior Floating Rate Bond. So it is our diversified, low-cost exposure to some of the largest and most liquid floating rate bonds issued by Aussie banks. So you can see the banks there and as well the credit quality in that fund. Now, the fund has offered a significant margin over cash since inception. So as you can see there, we've got the returns comparing to BBSW, as well as charting the margin over BBSW in the line chart there. As you can see, there was a bit of a dip in the recent market volatility, but that's since recovered. To continue the floating rate exposures we have in our fund. So a lot of our advisors have been supporting the BetaShares Active Australian Hybrids Fund, ticker HBRD. And really this fund has been a way for a lot of our advisors to manage a hybrids portfolio more effectively. As you know, hybrids can be opaque, difficult to trade, and also have terms and issuances that a lot of investors don't understand. So our view is that with an active manager, this is managed by Coolabah Capital, you're getting someone who is a professional manager, and their role is to understand all of those complexities and generate value in the fund. So the key thing with hybrid is not only does it have an income target, but it does have a capital preservation target as well. So income target is frank running yield, similar to the Australian Hybrids Index. So the current gross running yield is 4.27%. And the capital preservation target is you're looking at RBA cash rate plus 2.5% over the medium term. The key here for a lot of investors is that there is ability to move up and down the capital structure based on the valuations of hybrids. So the fund can actually hold cash bond sub-debt as well. We look here at the BetaShares Legg Mason Australian Bond Fund. So this fund really is a core fixed income exposure. It's actively managed and it's a diversified portfolio of Australian bonds. So it does include both corporate and government bonds. It's managed by a very experienced team at Legg Mason Western Asset, and the underlying managed fund, the unlisted fund, has been running for many years and is very highly rated by the key research houses there. Now, if we give a bit of an overview here on our Australian investment grade corporate bond ETF, so CRED. This is BetaShares' long duration corporate bond exposure. As you can see, there are some of the names that we are very familiar with. And the question is, for a lot of our advisors, why long duration corporate bonds, particularly now? And it really is that it's proven to have provided diversification to Australian equities. We've seen it sort of an inverse correlation as such. CRED's underlying holdings are corporate bonds that provide both credit and duration premia. What we have here is also an equal weighted, not liability weighted index. It's efficient because we're holding the liquid holdings in this space. And also a number of our advisors also use CRED in conjunction with coupon or hybrid or AAA to give investors more flexibility in selecting what they're wanting from their fixed income exposure. So blending it with a floating rate exposure allows you to amend the duration as per your portfolio construction outcome. So what we have here in this slide is the performance of, so CRED is in the brown line and the ASX 200 is in the grey shaded area there. So this is just since January of this year to May of this year. So I think it's as at 20th of May. So what we can see here is that in that severe market drawdown where we had in March of sort of close to 32% drawdown from the ASX 200, CRED didn't experience as much of a drawdown and really did provide that diversification in the portfolio for our investors. Now, if we look at our government bond exposures, so AGBT, BetaShares Australian Government Bond ETF, is a fund that specifically invests in long duration government bonds. So basically it's offering investors not only income over time, but also strong diversification benefits. The question here from our advisors, why invest in AGBT? And the real key is that if you do have concerns about credit risk, about the credit risk in corporate bonds, Australian government bonds have the highest credit ratings in the Australian bond market, and that's where the credit quality comes in. AGBT government bonds also offer diversification and defence. So diversification alongside equities in periods of market stress. And what you're also getting is regular income. So the longer a bond's duration, the greater sensitivity to interest rate changes. So the higher the income over time. So you are getting typically higher income than other Australian government bonds that aren't focused in this area. Now to cover our newly launched BetaShares Global Government Bond 20-year ETF, currency hedged, bit of a mouthful there, ASX GGOV. So what is this exposure? Adding to our fixed income suite, this is our global government bond. It's basically global government bonds within G7, issued by G7 member countries. So that's USA, United Kingdom, Japan, Germany, France, Italy, and Canada. You can see here, this is a bit of a summary page as to what's in the fund. So credit quality, your country allocation there, and then some of the names of the bonds that we're currently holding in the top 10 holdings. So again, what are the key characteristics here? So fixed rate government bonds. So these are the local currency bonds issued in each respective domestic market. So the fund has a maturity profile of more than 20 years. So it is certainly that longer duration government bond exposure. Now, each bond, each country weight is duration capped at 25%. So what does that mean? It means that basically no country will contribute more than 25% of the portfolio's total interest rate risk. And then also to note that the foreign currency, the fund is currency hedged back to Aussie dollar. So why invest in GGOV? As we mentioned before as well, similar to AGVT, is you are going to get higher credit quality in government bonds, and particularly by the government bonds issued by these G7 developed market economies. Secondly, you are getting diversification and defence. So again, government bonds tend to rise in periods of market stress, and then also attractive income paid quarterly. Again, income is certainly very important. You are getting compensated for being longer duration in the government bond space. So from a portfolio construction, portfolio application perspective, the key here for GGOV is that it is a more efficient use of capital. So what we're saying here is that there's less investment outlay needed to get the same amount of interest rate exposure. So what this table is showing here is, so here the S&P G7 sovereign duration capped 20-year, that's the index that GGOV tracks. And what we're saying here is that for every dollar basis point exposure, you would be needing only 26% as much capital compared to the AusBond composite here at the bottom there. So what could be a strategy for client portfolios is to use GGOV combined with floating rate note exposure, other corporate bonds, other private debt, to get what you need from fixed income, but also get duration exposure at less capital outlay. Now, what we've seen is that there is a large defensive potential in times of market stress with GGOV's index. So this table here is showing, so the dark grey bars is MSCI All Country World Index. The orange bar is the performance of GGOV's index over these periods of time, so in 16, in 2018, and in 2020. And what we've seen here is that GGOV has proven that it's performed well in these periods of market stress compared to the other broad market benchmark indices that in the same space. So the Barclays Global Treasury Index and the Barclays Global Ag Index. And the reason really here for this outperformance is due to having no corporate bond exposure. Here's just a summary page of the yield and maturity characteristics. So running yield, 1.81%. Average maturity, so as we mentioned, a longer maturity here at the 20+ years, and an average credit rating of AA. If we actually look under the bonnet, we've just broken down here GGOV's index, the Bloomberg Global Ag, and then the Bloomberg Treasury Index. What we see here is that GGOV's index in that pale orange, so the pale orange bars here, it is holding more of the higher credit quality bonds in the portfolio. So here you're looking at 70% within AAA and AA, and then the remainder in A and BBB. And so what we're summarising here is, again, the global bond indices comparison, GGOV, Global Ag, Global Treasury, and again, what we're seeing is definitely higher duration and also income potential as well from holding GGOV. So in summary, what we would say here is that the benefits of holding long duration, highly rated bonds in the form of GGOV, for example, is certainly the extra yield that you're getting. It's the diversification. And also the downside protection. So you are getting some cushioning on the downside in periods of market stress there. And as we mentioned before, depending on the strategy that you're looking at in clients' portfolios, you can blend it with other fixed income exposures to still get a high level of income, but you modify that duration and have a less capital outlay in your fixed income exposure. As you know, and just to finish off, so as you know, there's things to consider with investment. So there's investment risk. This information is general in nature. If you need more information, please download our PDS as well. We'll now move to questions. So I'll just... so a question here. Why has the return on bonds, so this is for you, Dave.
Yeah.
Why has the return on bonds not been as anti-correlated to shares in this downturn compared to the tech and GFC downturns?
Well, it depends on the time frame you're looking at. I mean, there was a period in March when we had basically a massive liquidity event where there was a rush for cash. So everything was sold, equities, gold, government bonds. You know, there was a brief moment in March where government bond yields actually went up. That was because people were dumping bonds to try to get cash to beat losses elsewhere, being collateral called. But basically, there was a dash for cash across the world. So everything that wasn't cash was sold. So in that brief period, it was true that bonds did underperform, or bonds did sell off while equities sold off. But that has now been normalised. So the Fed and other central banks came in, provided a lot of liquidity, and you've seen that credit spreads have come back down again. Bond yields have come back down again. So, so I would argue that's the main reason, was that extreme liquidity shock. But even that was just a short-term feature. If you look at it from a number of months, I mean, basically bond yields globally since late last year have gone down. And equities are certainly down from where they were last year. So you've had equities underperforming and bonds performing well.
Thanks, Dave. So another question here. Do you foresee the current and expected high government spending and with these debt levels and possible changes in credit ratings being positive, negative, or neutral for the bond market?
Look, I would say neutral. I mean, if you look at our bottom line for our market is that we had a 20% net debt to GDP for public debt, about 20% of GDP. All the spending, the deficits has been run up in this year and next. We'll take that to about 40% of GDP. So it's obviously a doubling, but 40% of GDP by global standards is still not that bad. And certainly by the global standards of next year, where debt in every other country will also have gone up, not that bad. So I think that financing will be digestible. And the other thing also to bear in mind is that a potential cap on bond yields going into next year, if it turns out the economic recovery is sluggish, and central banks still want to provide support, there's more and more talk of what's called yield curve management, where given they've already slashed short-term interest rates to zero, they can't cut them any further. They don't want to go negative. They don't see a lot of benefit. But what they can do is place a cap on longer-term bond yields. And they can do that by basically saying that they will target a certain bond yield and buy as many bonds as needed to ensure bond yields don't go beyond that level. So we've seen the RBA do that with 3-year bonds. They've got a target of 0.25% on 3-year bonds. And Bank of Japan obviously was the leaders in this a few years ago, and they targeted a 0% yield on Japanese 10-year bonds. So that could be another factor. If it turns out that, look, for whatever reason, a lot of deficit, governments going to the market to issue bonds around the world does put up the pressure on bond yields, and central banks suggest that that's unhelpful for the recovery, you'll see central banks acting to put a cap on yields. So that's, again, the whole backdrop to this is inflation globally was very, very low and is likely to remain even lower through next year. So it means the central banks can afford to, keep their, foot to the you know, whatever the term is, you know, on the accelerator in terms of providing monetary stimulus. But bottom line, all of this, no, I don't think the issuance that we're likely to see will put a lot of pressure on bond yields.
Thanks, Dave. I think the last question here, could we see stagflation within the next few years?
I don't think stagflation basically requires, if you think back to the 1970s, what's called a negative supply shock, where something very important goes up in price, in that case oil. So, you know, when you get the price of something going up, and this case was because OPEC, you know, restricted supply, that can have a negative impact on both growth and inflation, as we saw in the 70s. So what potential negative supply shock could lead to both inflation and growth, inflation going up and growth going down? I don't think it's going to be oil. You know, oil. I mean, there's a lot, you know, still excess supply of oil out there, and they'd like to be supplying more if they could. Now, the one scenario is, again, if central banks try to print a lot of money, you know, print cash to push up inflation at a time where growth is weak, people see that as a stagflationary environment. But again, I don't think central bank money printing per se, even if they do it, will cause a lot of inflation, because I get, again, structural reasons that are going to keep inflation down. But look, that is the one scenario in which it could happen if central banks around the world decide they're going to deliberately push up inflation at a time where the growth recovery does remain weak, and they're going to push that up by inflating by pushing out a lot of liquidity. I would actually argue if central banks did do that, you'll probably see growth being quite strong. So it could be an environment where growth is strong and inflation is high, in which case it's not a stagflationary environment, but just an outright inflationary environment.
Thanks very much, Dave. So again, thank you everyone for attending the webinar today. We will be sending the recording as well as the presentation slides that we covered today. Hopefully we have you joining us for our next webinar. We have a hybrids webinar next week with Chris Joy, who manages our HBRD fund. Again, thank you for your time, and we hope to have you join us again soon.